I'm Katie Lyles, the Events and Marketing Coordinator here at Lane Gorman Trubit, and welcome to today's quick chat. Here with me, I have a special guest, John Wellington, a tax attorney from LGT, and he will be discussing the proposed Biden tax plan.
Thank you, Katie. I'm happy to be here. I'm a tax attorney. I've been with the firm for about 7 years. I've been practicing about 23 years at this point. So I hope to go over the Biden tax plan with everybody.
Thank you. So, John, in 2021, we are going to see a new administration, and with that, a potential new tax plan. The Biden team has been very clear about their tax plan wish list. And what are some proposed changes that will impact the U.S. business owners?
Thank you, Katie. I'd like to preface everything I say here that anything I'm going to discuss is coming from the public information available out there. These would be based on statements made by Biden or his advisors or the campaign itself or other places. But certainly there is nothing, at least that I'm aware of, since the election that would give us any indication whether any of those proposals are no longer on the table or some of them are not going to be considered by the Biden administration. But as we know things stand today, Biden has been very clear that his plan with respect to his tax plan is that corporations should pay more, that the rate should be more progressive, and high wealth or high income taxpayers should be paying more, and also an emphasis on bringing manufacturing to the US and a big push to improve the renewables industry and give some credits and incentives to the renewables industry and take away some from the fossil fuels industry. So to be a little more specific than that, his plan talks about increasing the corporate tax rate up from 21%, where it is today, up to 28%. And that would also have some additional, penalties and credits available for bringing or offshoring US jobs. He's also talked about making sure there's a minimum tax on foreign earnings of US companies of 21%. With respect to the individual tax rate, he's talked about raising the maximum tax rate from 37% to 39.6%. He's made it very clear in all of his campaign, speeches, and he insists on his promise that no one under $400,000, no one earning less than $400,000 will pay any more in tax. But anyone earning more than that, obviously, based on everything I just said, is fair game. And he's also talked about eliminating the more favorable long-term capital gain tax rate for earners with more than $1 million of income, repealing the state and local tax deduction cap of $10,000. He has made a bunch of proposed suggestions with respect to trusts and estates, including reducing the exclusion amount available for estates down from currently where it is today of 11.7 million, back down to where it was when Obama took office, which would be 3.5 million. Perhaps more impactful to people listening to this is he's also talked about the potential of removing the rule that allows for a step up in basis of assets when the decedent dies. So that could create a larger tax burden on the heirs. And as I alluded to, he also has plans to eliminate certain fossil fuel subsidies and to create new credits for the renewable energy industry.
What industries are most impacted by this plan?
Well, certainly the energy industry is looking at some significant changes. Again, he's trying to increase, with respect to climate change as a backdrop, trying to reduce reliance on fossil fuels and increase renewables. So from a tax perspective, what he's talking about are things such as eliminating the deduction for depletion, the depletion for IDC, which is intangible drilling costs for oil companies. On the flip side, to encourage investment in renewables, he's talked about restoring credits for solar investment, for reducing emissions. And he's also talked about the potential to impose a carbon tax. That one probably bears significant is probably, something he's very serious about because he's also Janet Yellen is a supporter of a carbon tax, and she is his nominee for Treasury Secretary. For the manufacturing industry, again, he's talked about things to try to create jobs in America. So that would take what that means is he's talking about a 10% penalty on companies that offshore jobs out of the US. And he's offering a 10% credit to companies that open or modernize existing manufacturing facilities to revitalize the industry in the U.S. and obviously increase jobs that way. While it's not part of the tax plan, he would also certainly have less, let's say, volatility in imposing tariffs, and hopefully would provide some certainty to companies in that industry. The real estate industry is probably the other one with the biggest crosshairs on it. Again, his plan talks about lots of rollbacks of breaks for high wealth investors. He's talking about limiting the use of 1031 like-kind exchanges for individuals who earn more than that $400,000. Other related limits on being able to use real estate losses to offset income. And with respect to the new QBI deduction that was created by the 2017 Tax Cuts Jobs Act, he's also talked about limiting its use for those making over $400,000.
So, as we said before, these are only proposed, but after January 20th. How long would it take to get a new tax plan passed?
Well, that's a great question. I mean, I think it'd be easier to answer that question if we actually knew the composition of Congress. Probably everyone listening to this is aware that there's 2 Georgia Senate seats in a runoff. I believe it's January 5th. And if the Democrats win both of those, they would essentially control the Senate, with the VP being the tiebreaker. So obviously, to the extent the Democrats control both houses of Congress and the presidency, they have the capability to do things much quicker. Assuming that doesn't happen, and probably more has to break that way than not to get that result. If the Republicans have any say in the matter, they are going to be probably less open to some of these ideas discussed above, if not all of them. As a practical matter, even if the Democrats control everything, it still depends on how important this is to them and how they choose to go about doing it. So what I mean by that is, when Obama came into office, the first thing they were focused on was healthcare, and they didn't pass any tax reform for several years. When the Trump administration came in, they had control of both, the Senate and the House, but the Tax Cuts Jobs Act, any kind of tax legislation was a bigger priority for them, and so that was kind of the first thing that they did. And even then, they weren't able to, or I don't remember enough of the details, but they didn't really use the legislative process. They used something known as the budget reconciliation process to pass their tax legislation. So while that reconciliation process makes it easier, it also has its own issues with it, such as you're not allowed to increase the deficit beyond what they call the budget window, which is why you see some of the provisions of the Tax Cuts Jobs Act sunsetting in 2025. So big picture, until we even know what Congress looks like, it's hard to say kind of how much likelihood there is of any of this to happen, which would, the less likely it is, it'll take longer, if nothing else. And also, it's a big question whether this is going to be a priority to the Biden administration. I mean, I think it's pretty clear from, everyone knows what's going on in the world, and COVID-19 has been a big emphasis of what Biden has said will be his focus when he comes in the White House. And there's certainly no reason to think that's not going to be the case. So trying to get some controversial tax legislation passed just simply might not be the most important thing on their radar.
Well, with that being said, I think a lot of people are asking, are there things that a company can do to prepare for these changes as they start to plan for their 2021 budgets?
Well, certainly, the bigger the decision you're going to make, the more cautious you should be in light of the fact that we don't really know if any of this is going to happen. But let's put that aside. In theory, if you think that rates are going to be higher in future years, including 2021, then you're going to want to do things that will increase your income in lower tax years, meaning today, 2020. And you're going to want to defer any deductions or other tax benefits for later years in a higher tax environment. Um, Certainly, big picture, it's clear that the Biden plan will ultimately make C corps a less attractive entity type than pass-through entities. So today, if you're thinking about forming any entities, probably it would make sense to lean towards a pass-through entity when you're, just focusing on the tax consequences. Um, but more practically, if you really do think that there's a chance of higher rates in 2021, you could do certain things to bring your income into 2020, or you can bring, for example, you could pay your employees bonuses in 2020. While that would reduce the company's taxable income in 20, it would certainly reduce the tax on your employees. If you're trying to bring revenue into 2020, you might consider sending invoices to customers earlier than you would so that you can get some revenue in 2020 instead of 21. A similar story for capital gains treatment. If you think the rate's going to be higher, you're going to be a taxpayer that's at risk of paying higher capital gains in the future. You might want to consider, some those transactions in 2020. So those are things you can do to bring revenue into 2020. With respect to trying to defer deductions for future years when potentially the tax rates are higher, you might want to consider holding off on charitable deductions until 2021 instead of at the end of this year. And you might want to consider, when it comes to choosing a depreciation method, something that'll be less accelerated into this current year of 2020 and increase the amount that's available for depreciation in future years.
Thank you, John. Do you have any final thoughts on this topic?
Well, I mean, I think it's pretty clear that as much as we'd like to, we really just don't know a lot about what's going to happen next year. I mean, between the virus, between the elections being, the runoffs in Georgia, and a lack of, clarity of what really is going to be the most important thing when Biden and his folks come into office, I think it's important that we don't overreact to some of these proposals. And really, I think once after January 5th, after that Georgia runoff, we might have a little bit more certainty. But probably the best thing to do is just to stay informed and pay attention as events develop in the remainder of this year and into 2021. And typically, tax legislation is prospective looking. So I don't think there's any real concern about any actions being taken that, in the future that would impact the 2020 tax year. And it's possible a lot of these things would be prospective. They might not, to the extent something happens in 21, it might not even impact things until tax year 2022. So I wouldn't panic. I wouldn't be too concerned about things, and I would just kind of make sure you stay on top of things. And if you have any questions, reach out to your tax advisors.
Thank you again, John, for joining us. And thank you for watching today's quick chat. If you have any questions about what we discussed, or if you would like to set up a free consultation, please email us at askus@lgt-cpa.com. To stay informed on this topic, make sure you follow us on LinkedIn and follow our YouTube channel for more important updates.